Welcome to a new episode of 21 Shares Off the Block podcast. And today I'm very excited to have two of the three co-founders of Digital Asset, the core contributor of Canton Network, as guests. Before we dive into the conversation and also have both Eric and Yuval introduce themselves, I want to share a quick introduction about today's topic. For over a decade, blockchain has promised efficiency, transparency, and global settlement. But for traditional financial institutions, transparency has always been a double-edged sword. Public blockchains expose transaction data. Private blockchains isolate participants. Institutions have long faced a trade-off between openness and confidentiality. The Canton Network proposes a third path: selective privacy, interoperability, and regulatory-aligned infrastructure, purpose-built for institutional finance. This episode explores whether Canton solves DeFi's institutional privacy gap and what that means for the next decade of tokenization. And with this, again, I want to warmly welcome and say hi to Eric and Yuval. And how about you both guys quickly introduce yourselves?
Eric, go ahead.
Yeah, sounds great. Thanks for having us. I'm Eric Saraniecki. I'm one of the co-founders of Digital Asset, and I run our network go-to-market motion.
And I'm Yuval. I'm the less smart version of Eric, and therefore I just run the company.
So Yuval, you're like Max and myself.
Oh, you beat me to it, Darius.
Max,
Cool.
you also obviously a warm welcome to Max. And actually today is a very special episode for us, but we usually only have one guest. Today we have two guests. So thanks for both making the time. And also actually Max is not in the room with me today. So anyways, it's a very special setup. So we're a little bit more decentralized, but that's also one of the topics of today's call. And I hand it over to Max, who likes to call himself the good cop, and I'm the bad cop. I disagree generally, so you guys can also judge at the end which of us were asking the meaner questions. To start the rapid fire questions, over to you, Max.
Cool. Thanks, guys. Yeah, unfortunately, can't be in the same room as you, Darius. But I think I've seen enough of you over the last few months and weeks. Glad we get our own space as well. Anyways, first question, and we'll start easy, as I mentioned. I'm the good cop between us. And the first one is, how did each of you kind of first become involved with crypto?
Eric answer is going to be much more interesting. I mean, I was fortunate enough to start the venture team at DRW very early on, and really just was following Eric, who started Cumberland. So to be honest, I stumbled into crypto just because DRW was entering the space very early, and Eric is actually the guy who started. So over to you, Eric.
Yeah, I started getting involved in Bitcoin around 2010. Was just kind of very lucky that DRW had a lot of people that were very early in the ecosystem out of coincidence, and been involved in various kind of different ways. There were periods of time of mining. There were periods of time of running like cloud miners. I helped get Cumberland off the ground while at DRW around the crypto market making. But, the interest in the space has always been generally the same, which is that this is an incredible set of rails for larger financial applications. Yuval and I early days really identified that there was a massive shortcoming in the approaches of other ecosystems. And our focus was, okay, well, how do we apply what is, very interesting technology to a much bigger problem set. So even though we were both kind of drawn into crypto relatively early, I think it was more the sort of broader application that kept us in it.
Makes sense. Yeah, and I think that also kind of brings up a point that kind of, given that you both entered more from a professional angle, also builds to the point that institutions have actually been looking at it for far longer than I think people give credit to. Now we've been seeing a large shift of people and institutions happy to invest or be actually involved on chain, but this has been happening already behind the scenes for quite some time. The second question, I guess, is from a personal angle, what was the first blockchain that you guys actually ever used? Or maybe more interestingly as well, what was the first kind of real investments that you guys invested in, or which tokens you guys used in the early days?
Like early personal days? Well, I mean,
we all make mistakes, Eric.
No. I mean, when I actually, as a badge of pride, I've only ever really participated outside of Canton in, materially three ecosystems: Bitcoin, Litecoin, and Zcash. There was a flash of time in Helium, but generally speaking, been pretty down the center. And I mean, like I said, 2010, I really had one option. That was the one option, and it's expanded a little bit over the time. But I tend to skew more maxi in my general personal views.
Actually, I just wanted to say, because when you started in 2010, I believe like the first altcoin, Namecoin, came in 2011. So you didn't even have another choice. It was just Bitcoin.
I did buy name coins, but like I don't know, like you participate in different ecosystems at different. It's not that I haven't dabbled here and there, but the only thing I've ever really been in for any consistent long-term period of time is really Bitcoin, like Litecoin to an extent, and Zcash.
I think that also aligns a little bit on today's topic, where we will be talking about privacy as well. And Yuval, what about yourself?
Will be even more boring. Pretty much the only thing that I've invested in, if I invested, was Bitcoin.
Makes sense. I mean, these are some pretty PG-13 answers, compared to what we've sometimes had on, but we'll be interested to maybe talk a little bit more about that as we talk about the kind of privacy gap and institutional onboarding of crypto. And on that topic, I think the first question I have for you there is, when did you first become convinced that traditional finance would eventually move on chain?
So the early version of digital asset was actually to create more capital efficient infrastructure for Bitcoin. When you look at what does it mean to trade Bitcoin today, it's still fully collateralized. Now there's much more leverage, but early days it wasn't. And really thinking as a trading firm, what we're used to, we said let's just create an infrastructure how to trade Bitcoin more efficiently. And given that it was an on-chain asset, we thought, well, let's build the infrastructure and natively on-chain. So we started looking into how to actually build smart contracts or like on-chain application within the Bitcoin network with time locks and things like that. And very, very quick, we realized that, you need to have another set of infrastructure to actually solve that problem. On Bitcoin, you wouldn't be able to do that. And as we started thinking about that problem set of, well, if you can build a clearing for Bitcoin, well, why is that any different from any other asset class? And, I do think that coincided with Ethereum launching, but really the first paper or kind of idea behind Canton came in 2016, give or take.
Nice.
Yeah, just to completely agree with that. Our focus has always been, this is coming, institutional adoption is coming. I mean, even in the early days of Cumberland, the discussion was like, okay, well, what can we do to make the glide path for institutions into this space better? A big part of the liquidity provision decision making was, okay, well, you can, liquidity begets liquidity, more entities will come. So I don't think it's ever really been a question for us. And then maybe a little bit more philosophically, just the case studies that lie behind us of all the really successful networks, they are not, like retail disintermediation entirely. There are of course elements of that, but there are also tons of examples of the incumbents also participating at scale and or just winning outright. And so as interesting as the narrative is around peer-to-peer complete disintermediation, total decentralization, it's kind of interesting from a philosophical standpoint. We've never really seen that actually play out either. So I don't think it's ever been a question of, if. It's always just kind of how do we facilitate it and what's missing to facilitate it, and how do we make sure that that happens at the right scale and at the right timeline and with the right risk controls in place so that we don't create a bigger problem than the problem we thought we were solving. And so it's just, like I said, more when and how than ever if.
Makes sense. Yeah. And I guess, again, it talks to the point that I mentioned, that this has all been happening kind of behind the scenes for far longer than maybe most realize. I mean, Yuval, you mentioned 2016. That's already 10 years ago from now. I can't believe I'm saying that. But at that time, there were also, several kind of enterprise, let's say, blockchain efforts of launching enterprise chains, whether it be, Kinexis from JP Morgan, or whether it be the early IBM enterprise chain as well.
I think Hyperledger was the name, right?
Hyperledger, yeah.
And then we had Corda and R3 and all those funny projects.
Exactly.
If you want a piece of history, digital asset actually bought a company called Hyperledger. This whole Hyperledger movement actually got started by digital asset and IBM. And when we needed a name for the foundation, we were like, well, we just bought a company called Hyperledger. Here you go. You can take the name. Just a piece of history. Yeah, we bought a company called Hyperledger in 2015. That's where the name comes from.
That's quite funny. Well, wow, I'm learning more than I even thought I would be on this podcast. But there you go. Thank you. And I guess the question I had also, aside from, you guys lending out your name there, is what were some of the lessons that I guess you guys learned from those early efforts from different enterprises?
Yeah, I mean, I'll let Eric add, but the reality is that, like I said, Ethereum just got created, and in our view, Ethereum in many, many dimensions have really replicated Bitcoin from a philosophical point of view. And we don't necessarily have an axe against that philosophical view. It's just that if you're trying to solve something for enterprises, we think that that philosophical view does not jive. Whether you want for it to jive, a regulator would not be okay. You're in Switzerland, for example. In Switzerland, if I'm not mistaken, there's data domicile laws. Financial data is not allowed to physically leave Switzerland. That's why cloud providers in Switzerland have to have multiple data centers. So when Swiss banks use cloud, the HA and DR actually all happens within Switzerland. That's just a reality of the world, whether you like it or not, where you think it makes sense or not. But now suddenly you have Ethereum, which says, well, no, data gets replicated all over the world. That's just an example. So I think what ended up happening at that time, so we were thinking like, no, things need to happen natively on public chains, but we were not still able to prove how you could do that in a way that will meet all of the requirements of different regulatory frameworks, different business models, and therefore I think that there has been a good attempt at that time to start thinking, well, are there any intermediary steps how we can get enterprises comfortable with the technology? Very similar that when, internet protocols got started, you didn't have the internet on day one. You actually had intranets. You did actually start with intranets. And I think that was an important kind of evolution because people got comfortable and start seeing the potential of the technology. But the view was that at the end of the day, that is an interim step. And I think that the challenge that I see specifically in private versions of Ethereum is that they didn't try to break the mold of full state replication across everybody in the perimeter. So all that private Ethereum said is, we carry the model of Ethereum, but we now, instead of for the whole world, we're just going to do it for a subset of people. And the reality is that unless you're all within your own organization, even competitors, I mean, Eric sometimes says, which I really agree with, at least in public Ethereum, trying to figure out whose wallet is more challenging problem. If now you're just reduced, it to a private Ethereum across 8 banks, well, it's much easier to know whose wallet, and now you can see their activity. And I think that that's why a lot of the projects that have been across organizations on these private versions have never taken off. I think I will give credit to Corda is that they've definitely understand the requirements of the banks and their players and understood that even if you're doing something in a permissioned or a gated model, you can't have this full replication of data to everyone in that close perimeter. I think that where they missed is they missed the vision of how to then take that model and expand that to become a fully public network. So, I think that private permission chains were a natural way of how to get large enterprises comfortable with the technology, see the potential of the technology. It's just that when we started that, we still had this vision of how do you take that user experience and then transform it to happen on a public network.
Yeah, and just to add to that, I think the lesson that we have learned over the last decade on both sides of the aisle is that composability is the prize. And, so we've seen so many different examples of that. On the private blockchain side, a lot of the early experiments were trying to grapple with, well, okay, how do we segment data into different ways? And how do we kind of fragment the ecosystem from a data visibility and data permissioning side of things, but could not figure out composability. And a lot of those projects would peter out or not really go anywhere because when someone would ask the hard question, well, what have you really done here?
Yeah.
They couldn't point to something that wasn't just an internal optimization of some sort. And then similarly, on the public chain side of things, you had DeFi summer just completely change the map. And at the same time, you had all the L2 fragmentation, which were ironically recreating exactly the same mistakes of all the private blockchain experiments. Somehow less sophisticated because they didn't have any of the data permissioning or segmentation, thoughts. So it was like the most naive version of the private blockchain experiments failed for the same reasons. Like, oh, wow, I don't really have composability across these ecosystems. It's not really a scaling solution to the L1. It's a complete direct competitor to it. It's not complementary, et cetera, et cetera. So like this lesson has been learned over and over and over again in many waves. And we're kind of in our third or fourth wave of this right now with all the corporate chains that are popping up.
Yeah.
And luckily, I think we identified very, very early on that composability is the hill to die on. And so that's just been like the non-negotiable side by side with the hard restraint around privacy.
Yep.
And like that combination is what we've always been trying to solve for. And, it's really helped us navigate a fairly interesting decade of growth and experimentation, making sure that we always had those two things. One was like the constraint that actually lets people participate, which is all the privacy and control side of stuff. And the other is the upside and the utility and the value and the purpose to do it in the first place. And just kind of those two things being the rocks that we just kind of always designed around was a really strong guiding principle for us.
Well, thanks for clearing that up. I mean, I actually think you guys have, with your great answers, have answered a few of the questions we had in mind.
I think we can just end the podcast like we just covered.
Yeah, thanks a lot for thinking in advance and ahead. But, we should have kind of anticipated that, given that you guys were also early thinkers of, making privacy really a prerequisite, but still having that feature or that end goal of it being. So shouldn't have been surprised that you can predict a couple of podcast questions there.
And actually, Max, you already hinted to my first question for Eric and Yuval, which is, do you guys, and I think it's more of a rhetoric question, but obviously we want to cover this topic of privacy, which is also Canton having a big focus on. Would you say privacy is a feature or a prerequisite?
So I think that, a lot of times people will come and say, Canton was built for regulated institutions. And the answer is that is incorrect. Canton was built to also satisfy the requirements of regulated institutions. And I think that that's an important thing. It's almost like saying hey, the internet would have only worked if it could support Craigslist. It's just not that. The internet wouldn't be what it is today, right? I mean, so our view is that privacy was a must-have, because if you're truly trying to build an open network that can satisfy everyone's requirements, privacy is a must-have or prerequisite for many use cases. And I think that the part that a lot of people in this space underappreciate is that when you go away from censorship resistance assets, aka Bitcoin, Ethereum, Canton, and others, the only value for smart contract chains, in my view, is real world assets. And if real world assets is the only is really the holy grail, or kind of like the big unlock for these chains to become kind of like the backbone of a financial system, you actually have to represent the assets natively on chain. And if you have to represent them natively on chain, you need to have privacy, because a lot of things that are associated with these assets cannot just be shared with the whole world. And therefore, what you've seen is that for the most part, today, all the assets that exist on public permissionless chains are really just claims against traditional systems that all exist off-chain. So it's not, a lot of times, like people say, it's not that privacy is a must-have in every situation. There's a lot of cases where having no privacy is actually a good thing. It's just we believe that if you really want to have a true piece of infrastructure that can support, becoming the rails of a financial system, in many of those cases, privacy would be kind of like a prerequisite. And then I will just build on top that, I also think that retail, if they knew that they can do payments with stablecoins with privacy and you wouldn't be able to trace back, when I started talking about privacy, like in the last few months, a lot of times I came from the very rational, like, hey, as an enterprise, you have fiduciary duties. And then I just kind of dumbed it down as, the people that are being kidnapped in France also wish there was privacy on chain. It could also become real on a personal level, why privacy is so important. It doesn't also just have to come from regulatory requirements or business requirements. It also, at a personal level, in my opinion, privacy is an important.
Definitely. And actually, I mean, I didn't mention it in our introduction, but I also focus on the venture side. And we just had a call with the founder who is building a privacy project. And the reason why he's building it is that he was actually kidnapped at his house, also in France. And this made him actually like start like building like this like security mechanisms for others. So really like out of like a personal situation. So I really like this nuanced answer. The next question I have, just in the sake of time, so we can also cover some other points for the podcast, is do you guys like the term real-world asset tokenization, or should it just be asset tokenization? Because I feel, especially when we talk with people who are outside of crypto, it's like, so there's fake assets and real assets, so what's the, and especially me doing German and English translations, it sounds so weird. So what's your take on this, like, naming?
My view is, listen, I think that there's an important component for the real world in the sense that, again, there is a distinction between an asset that has an issuer behind it versus not, right? Like Bitcoin and Ethereum and Canton Coin are made up assets that eventually, as a result of either the utility or the system of belief around it, have created a value, but it's not, there's nothing in the real world that has anything to do with that asset. So I think that that distinction of being a real world, specifically in the context of crypto. But honestly, I do use the word tokenization quite a lot because I think it became almost a standard. But I actually think it's misleading in a bad way because it does create this kind of like almost a sense that you have the original asset and now you have a tokenized asset. Are they not the same? Do you not get the same rights if you hold this asset versus the other one? So I, generally speaking, when I talk to people, I talk about, on-chain equities. It's not different equities. It's not like special equities. It's just equities that now are using a chain to mobilize them. And that already today happens in many cases, right? I can send you equities through Swift. I can send you equities through Fix. I can send you equities through multiple kind of rails, but you're still sending the same asset. So even before crypto, we did talk about mobilizing assets, money, credit cards, bank wires, like you're still doing the same type of asset. You're just using different rails. I wish for us as an industry, we said, hey, what we're trying to solve is we're trying to mobilize the same asset just on a much better, more sophisticated set of rails.
And to your point, I think it's a label that, over time will also be shed. I think when we went from, e-trading, paper trading to e-trading, people were calling it e-trading. This is even before my time. But then, over time, as everybody became accustomed to trading being done electronically, people just dropped the label E and it became trading. And I could see a similar trajectory here with representing real world assets on chain, even though, Darius, I also get your point that it makes everything that's on chain potentially seem that it's a fairy tale land. So I can see both sides of the coin.
Well, and I also agree with your point, Max. Like, I think down the line, we reach full like blockchain adoption when we don't even talk about blockchain and we just talk about trading because it's just the underlying infrastructure hidden behind. The next question I have is more from a personal interest because Max and myself, we are both researchers. What is one metric that you guys closely watch on Canton Network?
To me, it's very simple. And a lot of times people in crypto have got used to TVL. I think TVL is an interesting point, but I actually think it's not the most important one. So the way I think about it, it's just dollar utility, meaning how much dollars people are willing to spend. Meaning if you seeded an asset with $10 billion of capital, so let's just say, but then you parked it and you've never used it ever again. It just kept on paying you a premium once or like some kind of interest once a month, but you never used it. Is that a good outcome for a network? I think it's not, right? So TVL to me is not that interesting. To me, what I'm much more interested in is dollar utility. How much dollars get spent on a network? And I would say even more important, in my opinion, for this industry, it's how much dollar utility gets spent on non-crypto related activity, meaning you're actually using this truly as a piece of infrastructure, not as a speculative instrument. So I use stable coins is a great example because a lot of times we use stable coins as the best product market fit that we currently have. But then I would say, okay, well, how much of stable coin movements are for crypto trading versus making payments for companies that have nothing to do with crypto, but they just found that the rails of crypto are so compelling that they're using it for their day-to-day business activity. So I would say activity in terms of dollar utility, And then what is the ratio of non-crypto to crypto activity that is happening on chain?
Yeah, not surprisingly, we have a large agreement here. I say it slightly differently. Like, if we believe that the value of this new infrastructure is to increase the utility of assets, well, we would see it through things like a measure of velocity. And TVL is definitely similar to like the comments you've all made before about a stepping stone towards a goal. There's nothing wrong with it per se, but it's definitely a misguided focus, because it's not the thing that tells you whether you're actually providing the utility that you claim to be providing. Parking money there is one thing, spending money with higher frequency is another. And I think it's very telling that if you look at stablecoin velocities, they're actually well below current USM1 velocities, just to further the point that we're very, very far away from actually demonstrating the true utility of these ecosystems. It's still early. And I don't say that to be pessimistic. It's more to say that, to the question earlier, is this a threshold issue? We think that it is. We think unequivocally it is. Where there has been success thus far, it's entirely within the crypto casino. It's really not pushing outside of the crypto ecosystem yet. And you can see that in just about every metric. Now, TVL happens to be in absolute terms a pretty interesting one, especially when you look at the market caps. So a lot of these tokens, it's enough to kind of capture people's attention. So it has its purpose, but it's definitely the wrong metric. If you are truly focused on the utility of what you're trying to bring to market, then TVL is not the most interesting metric. Velocity, some measure of velocity is.
Okay, so we learned what you guys are looking for, and also which metric you don't like at all. Or like, I'm exaggerating, but I see very much your point. So less about the static TVL, but more about like the utilization of the actual assets on chain, which makes a lot of sense. Maybe moving again to like risk and institutional adoption. What would you say is one risk of institutional blockchain usage that's underappreciated?
A risk to them as the user. We have another hour. So there's a lot of very subtle design decisions in Canton that take a lot of these risks into account. One of them, you can disagree with how much of a risk some of these things are, but they do fundamentally change the profile of the asset. So when you deploy an asset into an ecosystem with a pseudonymous pool of validators, you are in very important ways kind of giving control of that asset to those pseudonymous validators, and you can get non-deterministic outcomes. Now, it should be an edge case. It should be unusual. It should happen only in the extremes. And so you can, decide how much of an impact or risk weighting you should assign to that. But it is different. And I think that's the mistake that a lot of people make in this industry, is that they try to wish away these deltas because they're probabilistically low, as opposed to accepting them and either presenting an alternative design approach or arguing what the real risk of that is and thinking about a number that would be a reasonable number. But too often people try to pretend like it doesn't exist. So the outsourcing of control of your asset to a pool of validators is a big one. That's a really big one. I think it's one of the subtle underlying motivations for a lot of the corporate chains, is that they want to be certain that they're going to get the deterministic outcomes over their assets that they want. We have stablecoin TVLs that I think at this point exceed the staked position of Ethereum. So that theoretical of the assets being worth more than the money at risk is there, or very close to being there. I don't remember off the top of my head. And so you have to take that sort of stuff into account. You have to think about it. So that's a very real one, is the sort of deterministic outcomes of the validation of your assets. The variability of fees, even though they're very low now in most ecosystems, was always a big one. But even so, again, another motivation for a lot of the L2s that are coming out right now is denominating fees in your own currency, stable fees, stable approaches to it. It's addressed in a lot of different ecosystems, but there's some subtleties there. But then you've all touched on this before, and I think it's a really big one. It's just there are new intermediary and depository risks being introduced in a lot of these assets, the way they're being brought to the market. And again, similar to my first comment, you can say they're minimal, you can say they're on the edge case, you can say all that sort of stuff, but you do have to take them into account. You do have to have a plan for it. You do have to risk weight your behavior accordingly. And like it or not, and this industry likes to, again, wish that it wasn't true, a lot of these things are untested in court, in adversarial scenarios, in catastrophic scenarios. And so sometimes you'll only have a theoretical. Now, all of that sort of stuff influenced our decision-making in Canton. We don't force you to take those risks as an issuer into the network. You can configure your assets in such a way you don't take those risks. We have all the right properties on chain that it can be the true legally binding asset that survives through bankruptcy, that holds up to all existing bankruptcy law, court proceeding. We've taken a lot of this stuff into account in the approach and the design. It produces a lot of very subtle differences in how the protocol works, but they're critical and important. And it's what's allowed us to bring capital markets at scale on chain, going as far back as into the Gensler era. People in the US were willing to use this technology at scale because they could meet every single existing regulatory requirement that they have without fundamentally changing the risk profile of the asset, solve a real problem, and not introduce a whole bunch of new risks. There are just some very real properties that are different in these ecosystems you have to take into account.
I think that's a great answer. And with this, I come to the last question of our rapid fire question section, which is actually my favorite question, but I think maybe also sometimes the hardest. And I want both of you to answer it. If you had to describe Canton in one word, what would it be?
One word? I get one word or one sentence?
One word.
Who wants to go first?
This is why he's the bad cop.
I know you were saying
earlier.
that.
I can go first. I'll say pragmatic.
Eric, we can take advantage of the fact that they're interviewing for the first time two people. So you can say one word and I can say another word that comes.
Actually, yes, that's on for advantage.
So I'll go first and then you use the word because I know, and I'm going to say very, and then Eric, you can say the other word.
Pragmatic, okay.
Yeah,
Cool.
I said pragmatic.
Makes sense.
And if you quickly
well
want to
played,
elaborate,
Am I allowed 2 words in the elaboration, or
you're
can
allowed more words than 2.
Yeah, I would say that sometimes we get asked the question like, oh, how did you come up with Canton? And it's so different from everything else. And I think that the very real answer to that is it's driven by hard lessons learned working with customers in production over an extended period of time and managing to be pragmatic and make honest trade-offs through that process with that focus of making sure that we land on something that can work and still delivers value. And oftentimes, I think a lot of the other approaches are religious. And I'd say that that's kind of at the core of a lot of our deltas in the design principles.
Yeah, I think that, and this maybe is too much information with respect to the question. I want to make it a bit more real what I mean by when Eric says pragmatic. So I get into this argument a lot where people say to me, decentralization, censorship resistance, trustless, all of that stuff is the most important thing about blockchain. And then I say to them, okay, but how is that relevant to a real world asset? You've effectively given up all of that by trusting an issuer. And by the way, and I don't necessarily think that that's a negative thing. At the end of the day, there's a lot of value being able to mobilize claims against an issuer of assets. Like there's value in that. But, I try to explain to people, you have given up that value. And because they keep on saying the best usage of stablecoins is just being able to move them on trustless infrastructure. And I said, but the issuer can freeze your assets at any given point of time. So the fact that it runs on this trustless decentralized infrastructure really doesn't give you that much edge, which is very different than Bitcoin. On Bitcoin, they cannot censor you, which is the value of that asset. So when Eric says we're pragmatic, we try to understand those kind of like issues or things that are just grounded in reality. And then we say, okay, with that understanding, how do we actually build a pragmatic solution that actually takes advantage of the technology, but with regards to things that are relevant? So Eric will, for example, say composability. Our view is that composability should be decentralized and trustless, meaning there's a trustless infrastructure that if you had the right to compose 2 assets together, no one can censor that transaction. And that is a good thing. But if you're doing like, it was all on X yesterday. If you're just only doing a peer-to-peer transfer of a stable coin, honestly, putting that on a public permissionless chain, other than the statement about distributions of wallets, really has no value. You don't get any additional benefit. You're actually really running Venmo on the most expensive database in the world. That's all you're doing, because all you're doing is you're moving claims against one centralized issuer from one account to another. And you're doing that on the most expensive database. And that's why you're seeing a lot of the stablecoin issuers now creating private chains, because they're saying we can actually do that much more efficiently. But if you actually then say, well, but then you lose composability, that's really where the value of a public permissionless chain comes. And that, to us, that nuance a lot of times in the broader crypto community people don't like that answer because you kind of
I
like
just wanted
break
to
the
say,
narrative.
you broke the narrative, but I would also argue that some people like prefer like, like neutral settlement rails, and they say like one of those like stablecoin chains, they're not as neutral as Ethereum. Like if my competitor is building this, why should I deploy there? So there's also like this argument on the other side, I would say.
Yeah, that's true. But again, you've effectively, if Circle doesn't like you, Darius, you have nothing to do. It doesn't matter that it's settled on Ethereum. If Circle doesn't want you to own USDC, they can block you. It doesn't matter where it settles. So inherently, USDC is not neutral. It's just not. The second that you go into a real world asset, you have effectively exposed yourself to an unneutral issuer that comes with biases, requirements, regulatory. After the Venezuela thing, there was like $200 million of Tether seized. Like recently, $500 million in Turkey. What does it matter if it's settled on a neutral infrastructure? You're exposed to that risk. That's the only point that we're making is it's just what is the value that you're getting from this infrastructure, I think is something that a lot of times people answer because they're very dogmatic about the technology and the industry, which is, I guess, why the industry became so big, which is a good thing. But when you go back and you're saying like, okay, but we're trying to be pragmatic and just solve a problem, I think that it's important to kind of remove these biases and really just look at it honestly. By the way, I'm very always open to hear like arguments why we're wrong with our view. It's not, again, we're not coming at it from an ideological, other than we believe that there's a lot of value and merit to the technology to make the world more efficient.
You guys come more from a pragmatic standpoint.
But
actually, moving back to Canton, both Max and myself being Swiss, we are both calling from Zurich, Switzerland. 21 Shares is headquartered in Switzerland. Obviously, the name, first time I heard about Canton Network, like ringed a bell. And I was like, is it a coincidence or not? Do you guys maybe want to tell the audience like why Canton Network, and also for maybe the viewers who don't know, cantons is what we call the states in the US, like the different jurisdictions. So how did this name come upon? Were you guys in Switzerland? Were you guys interested in our political system? So what was the story behind Canton Network?
I think can also explain, some of the architecture behind Canton, probably, and it kind of ties those two together. Because we've talked so much, I think, already about the kind of institutional gap on onboarding institutions, which was kind of our first topic of the deep dive. I mean, you guys have been great, but you've just answered kind of all the main talking points that we had in mind. So yeah, go ahead, give us a little bit of the lore behind it.
I'll take a quick stab, but I think Eric tells it better. But, another thing when we started, and I think it was inherent, I think, Darius, when you and I talked about the privacy, is it a prerequisite or not? I kind of insinuated that at the end of the day, our view is that the world is not, and I didn't say it as explicitly as what I'm saying right now, but the world is not homogeneous, right? Again, like the internet wouldn't be successful if the only website on the internet that could work is Craigslist or right? Like the nice thing about the internet is that the internet is a very thin protocol that actually puts effectively the requirements of a website on the website creator. Is it a permissionless website? Is it a permissioned website? Is some of it permissionless? Some of it is permissionless? Does it have privacy? Does it not? Like you decide, and then the protocol can enforce. So our view was that just the world is not homogeneous, and you really need to allow the smart contract designer to decide what are the characteristics of a smart contract application, rather than the protocol telling you, this is how it works. Now you figure out how to work with it. And that's why I think I stated is that a lot, if not the most, tokenization projects that exist today on public permissionless chains actually do most of their work off-chain because they cannot just be compatible with the very, very kind of like deep assumption of how the world should work, right? Like most public permissionless chains, there are very kind of thick protocols that kind of tell you this is how we think the world should work. And you figure out how to fit within that view. So that's just kind of like, philosophically, our view is that chains should allow for heterogeneous applications to coexist on the same protocol and even be able to interact with one another without violating each other's characteristics. So if I have a fully public permissionless asset and I want to compose it with a very permissioned asset, I should still be able to do that on the same protocol and have the same characteristics of composability. So that's just kind of a philosophical approach when we start building Canton. And then the nice thing is all of our engineering team is in Zurich. And when you really just think about kind of like the model of Switzerland, it's a very well-organized country, but that is very different. I mean, you spell the canton of Zurich is canton with a K. The canton of Geneva, it's with a C. You can't even spell your cantons the same way. You don't speak the same language. You have rules about cows different between every canton. Like you do things very differently. Yet when you take a train between cantons, you're not like, oh, I'm moving from one country to another. You're still in Switzerland. So this idea that you could have a whole set of heterogeneous applications coexist on one layer one and interoperate with one another was, in our opinion, like just a really nice story that, it was developed in Switzerland, but it also kind of, from a philosophical perspective, kind of have the same characteristics.
Yuval, I just love this analogy with the trains. So it really resonates with us.
Yeah, and you're talking to two people who are, originally from different parts of Switzerland as well, which is quite funny. So, and I still get along with Darius,
I mean, we consider, I'm based in the German part. He's based in the French part. We actually call you guys French, so we don't consider you Swiss.
And I take that to heart as a person who has background from Belgium. Yeah. Anyways, thanks for that. And Eric, do please chime in if you want to add to the story.
I don't have much to add to that at all. I think you nailed it.
Cool. I mean, on our side, we had a few other topics kind of around the architecture, which I think was already well described by yourself, Yuval, and also kind of alluding to why you guys didn't opt in for a more, let's say, open kind of consensus model. And I think
see, I'll push back on that right away. Thanks for
you answered on that exactly.
Well, no, I mean, I think that there's this real misconception that the network is somehow less permissionless than others that I like kind of have a real hard time with, because there are securities on Ethereum that are heavily guarded through KYC and whitelists and permissioning, and there are some there are some that came to market that were so extreme that you had to be in the same country as the issuer to even have a phone call and talk about it. So there have been some extremely permissioned assets that have come to market through Ethereum. Ethereum doesn't get labeled as permissioned, and the fact that we just kind of give these issuers even more controls so that they can meet even more of their requirements and not have to work around it. Again, the network, anyone can take the open source software and go and deploy whatever the heck they want right now. Can they connect to anything in the ecosystem? No. Just like I have a browser, I don't get to just go into any website on the internet right now. And I just think it's this disconnect between there are the properties of the protocol and the ecosystem, and there are these properties of the applications, and that the protocol doesn't impose upon those applications a certain set of rules that would make it difficult for them to do what they need to do and to give them greater flexibility to meet the requirements that they have. Yeah, in our go-to-market motion, we brought a lot more institutional stuff live than others to begin with, but that's where we have immediate edge. So,
it makes a lot of sense.
Yeah, it's a network for everyone. There are elements of it that are totally decentralized and permissionless. There are elements of it that are incredibly locked down.
Exactly.
But the cool thing is it all coexists.
No, exactly. I think again ties into the Canton point that Yuval was mentioning earlier. And I honestly wish we had you guys for a lot longer than we do. It's been great already learning about things that I didn't even know about myself, even though I did do my homework before stepping in today. But again, as I was telling them earlier, we can actually see the Canton office right from where I live, at least. Or maybe next time.
Digital asset office. There is no Canton office.
Sorry about that. So maybe next time when you guys are around, we can do this live. Before we let you guys go, though, I did want to ask one final kind of more forward-looking question, which is kind of two-part, I guess. But what would success for the Canton Network look like in a few years from now? Yuval, you mentioned this earlier, that your opinion is that tokenization or real-world asset tokenization is the kind of biggest end goal of or the biggest kind of target for crypto at the moment, and how big do you think that market can also become realistically in the next few years as well? Because there's a lot of projections that are numbers being thrown out, and just curious on your view.
So again, if we take the characteristics that I said of what we look at, which is dollar utility and how much of that dollar utility gets spent on things that are not inherently crypto businesses. That's the only thing that we look at a digital asset. And I would say for the most part, most of the participants in the Canton ecosystem are our goal. And if you're asking me from a TAM perspective, I actually don't think we need to wait for assets to be issued natively on chain. I mean, the project that we're doing with the DTCC is bringing existing assets. So when you look at the TAM, I mean, look at how much people spend on money processing, on collateral processing, on securities lending, collateral management. I mean, we can take quite significant industries. We do work in the insurance space on Canton. We do stuff in commodities. I mean, at the end of the day, I actually am very much aligned with the value that people attribute to this ecosystem, because the TAM is, to be honest, too big to even discuss it.
Yeah.
I think that I wish that it was distributed to actually where the value was being generated, but I think eventually that's where it's going to go.
Makes sense.
I say, I don't know if this is a true statement, but it feels real to me that we're the last industry where when I click the button, it doesn't actually happen. You know, like just about every other industry in the past decade, I click the button, I watch the movie on my phone. I click the button, the person gets the message. I click the button, I'm talking to whoever I'm speaking to.
Yep.
You know, all that sort of stuff happens. And today in finance, that still isn't true. I mean, that experience is being presented to the user, but under the hood in reality, it could be a
Doesn't
2-day,
matter.
5-day, 30-day, 3-month process. Ironically, some of the lowest latency businesses have some of the highest latency settlements. You look at like ad tech and stuff like that. So in the financial space, it is still very much this massive disconnect between the plumbing and the experience. And what really happens under the hood is not when it gets presented to the user. And what happens is that actually creates a tremendous amount of friction and risk and locked up capital and just all sorts of just tax. I call it like tax on society. It's not really to anybody's benefit. There are these micro pockets of those that do benefit from it, but generally speaking, as a whole, it's net negative to the broader society. And so, yeah, if we're super successful in 5 to 10 years, we as an industry, then click button actually happens is going to be true in finance. And that'll be a really
Great. Well, thanks a lot for that. I guess you guys could call yourselves you guys are also plumbers then, in a sense. You guys wear so many different hats. Nevertheless, thank you both for taking the time. Wish we had longer again. It's been a pleasure learning about, your guys' history, the background behind how you guys came up with Canton Network, and also the people behind Canton Network or the team behind the people. Anyways.
And also not to discredit the other guests that we had in the past on the podcast, but I think like we had some of the most thoughtful, nuanced answers to our questions than in any other podcast, I would say.
So Darius this time was actually paying attention, so it's good to have him on as well. All jokes aside, if for our viewers, if this is maybe one of the first times that you guys also hear about Canton Network, because the token kind of went live towards the end of last year and the mainnet was only live for the last few years now, please go ahead and check them out. We've also posted quite a few research pieces on them as of late, so go ahead and check that out as well. From our side, that's it for now. Next time I'll be in the room with Darius once again, so look forward to joining you there. Thanks a lot. Go ahead, put a like, subscribe if you're watching on YouTube, and otherwise also follow us on Spotify. Thanks a lot, and take care, everyone.
Thank you so much.
Thank you.
Bye, guys.